And also and the next thing that makes index funds extremely attractive, apart from the cost, is the fact that when we actually look at performance, they have done much better than the average active mutual fund. And
Mm.
so when we combine these two together, it's almost a no-brainer to invest in index funds compared to active mutual funds, or in other cases, actually any other investment style.
Hello and welcome to the Woke Finance Podcast, the podcast discussing all things finance and all things finance related. It's your boy Peter, and I'm with my bro, my co-host Jax. How are you today?
Yes, Peter, I'm doing very well. I'm very excited. Here in the UK, as our old listeners will know, me and Peter are both football fans, even though we support two different teams, two competing teams. We are both huge football fans, and we have restarted the Premier League season here in the
Come
UK.
on.
And that's just not just the UK, across Europe, across the world, most football tournaments will be kicking off. And for me, that makes for an exciting season. It feels like we are back to normality. We are back to watching weeks of football. We're back to arguing. We're back
Mm.
back and forth. Really exciting.
Come on, come on, come on. And on that note, our teams are facing each other. I mean, by the time this comes out, we would have already know people know the scores between Arsenal and Man United. But yeah, shout out Arsenal, all the best. We'll see. If we in the unlikelihood, or who knows that we have a player that listens, well done to my Arsenal teams. That's what I'm gonna say.
No comment. No comment.
But nah, man, good to hear from you, my bro. And massive shout out to our listeners all over the world, wherever you are. We see you, we appreciate you. And yeah, man, we're just grateful for your ongoing support of the Woke Finance podcast. Now, Jax, every now and then we touch on some topical subjects. And right now, one of the subjects when it comes to the finance world, so to speak, are index funds. Now, we've spoken about index funds before, but we are going to take a bit of a deep dive, particularly in relation to why it's topical. But I guess before we take into a deep dive, why is the topic of index funds even coming back up or rising back up right now?
Yeah. So, I mean, look, there's always a conversation about index funds and whether investors should be prioritizing index funds over actively managed mutual funds, or whether people should be stock picking, etc. That's always going to be a conversation. But it's become even more of a bigger conversation now because when we look at the index fund, the most popular one that is a proxy for the American index is the S&P 500, which captures the largest 500 public companies in America. So the question is, why is it topical now? It's topical now because when we look at the S&P 500, which historically would have been a good proxy because it has the largest 500 companies, is well diversified, actually, because it is a market weighted, market cap weighted, which means the bigger the company, the bigger the percentage it holds in the S&P. It means now when we look into it, actually the top 10 companies in the S&P 500 represent 40% of the whole index. That is huge. That is massive. Again, that
Wow.
10 out of 500 companies represent 40. That's 40% of the whole index. And for that reason, the question is, is the S&P 500 still a good way to invest for the long term? Is it still a good representation of the whole economy and that kind of stuff? So that's what's topical right now. And people are asking, should we still be investing in the S&P 500, or should we consider active investing?
Wow, and Jack's just maybe for our listeners as well, those top 10 companies that represent about 40% of the entire S&P 500. That's in terms of market cap, right?
Yes, market cap.
Yeah.
Market cap essentially is the size of the company in terms of its, let's say, how many shares it's got outstanding, and of course the value of those shares. So just to throw a few names out there, Nvidia being the biggest, we've got Microsoft, Apple, Google, also known as Alphabet, Tesla. I think even Broadcom now is in the top 10. So these companies, I don't know if I'm missing any, but if I am, you could throw them in, Peter. These companies are the biggest companies in America, in the world, really and truly. And yes, they represent a huge proportion of the index now because of just how big they've become.
Now, what's scary about that, Jax, or I wouldn't say scary, but what I probably noticed, those top companies that you mentioned, they're not too dissimilar when it comes to the to sectors. They all have a role to play in some form of technology. They're all, some of them are leading the whole AI talk, which no one ever knows what it really means, but I'm sure we'll find out in 5, 10 years and stuff like that. And the reason why I say that, because doesn't that mean if they are all quite concentrated on, one or two sectors, um, what happens if there's like a major crash in those sectors? Like what does that actually mean for the S&P 500?
That's very good. That's very, very good. So yes, you're absolutely right that these companies I've mentioned, most of them will be in one of the or two of the 11 sectors that exist, which is technology, information technology, and the other one being communication services, which is very similar to technology as well. One could argue that Amazon is in consumer staples, but really and truly, if you really look into the business, it's quite technology.
Mm,
Well, so you're right. When we look at the sectors, these sectors, and why they even exist is because they have characteristics. They respond to macroeconomic environments differently. Some are more cyclical, which means when things are great, they do very well. When things are bad, they do very bad. Some of them are more sensitive to things like changes in interest rates and that kind of stuff. So you're absolutely right that the sector does matter. And because we are very much concentrated in these very few sectors, if something happens to affect that sector, yes, what that means is the S&P 500, because it is represented by these companies that are all concentrated, it will swing it down quite a bit, right? The flip side is also true. When we look at the S&P 500 and its growth in recent times, even though the broad market probably should have been flat or gone down because the top companies, the top 10 companies have done so well, they've actually pulled the whole S&P 500 upwards. So it just means that we're more dependent on the performance of those top companies, and what it does is it makes you a bit more susceptible to wild swings.
hmm. No, I love that. Thanks for that explanation, Jax. Now, index funds, Jax, have been, a topic for a couple of decades now. It was made very famous and even more famous and popular by Mr. Warren Buffett himself. If you remember Jax, yeah, if you remember Jax. And so I guess it'll be good to hear from you, just so a reminder for our listeners, a bit about that, but bouncing off on that in terms of just explaining why index funds and why is it, yeah, such a interesting topic.
Yeah, so I think in one of his shareholder meetings, um, someone asked him if he wasn't a professional investor, or if someone, not him per se, but if someone wasn't a professional investor, didn't have time to research and look at stocks and stuff like that, what would he advise them to do? And he says clearly that for that person, they should be investing in this index fund. And what is this index fund? This index fund is one asset is a pool of assets, basically. It holds 500 companies. We've been talking about S&P 500. So the analogy I like to give is rather than going to the shop and buying individual chocolates, you can go and buy a chocolate box. Like here in the UK, we've got like celebration box, or what's the others? Quality Street and Roses and stuff like that. So by buying that one purchase, you actually have a mixture of a whole bunch of different assets or companies, or in the analogy, chocolates. And the reason why someone would do that is because they get that immediate diversification. And also they don't have to actually think about what companies actually go in there. What makes index funds very, very attractive to the average person, and why even Ron Buffett was talking about it, is because they are very low cost. What that means is very cheap to run, because what the fund manager has to do is to literally just copy what's happening in the index, right? He doesn't have to do any active management. There's no extra resource that goes into trying to beat the market. And also and the next thing that makes index funds extremely attractive, apart from the cost, is the fact that when we actually look at performance, they have done much better than the average active mutual fund.
Mm.
So when we combine these two together, it's almost a no-brainer to invest in index funds compared to active mutual funds, or in other cases, actually any other investment style.
Now, I mean, for the individuals that first heard about index funds, and maybe if that time is now that they're first hearing about this. It does sound quite attractive. Obviously backed by Mr. Warren Buffett and everything you've just said, low fees, fairly straightforward to run, and generally good performance, which is quite impressive. And that sounds quite exciting, Jax. I mean, if I was a newbie and I heard this, I'd be like, yeah, let me put some money in the index funds. But with anything, Jax, there's obviously pros and cons. So I guess what are some of the disadvantages of investing in an index fund?
Yeah, you're right. And I think it's actually very important that people understand that there are disadvantages. You hear some stuff, especially when it's coming from the Oracle of Omaha himself, to just go and follow. But no, index funds do have some drawbacks. One of the ones being, or the most obvious one I could think of, is the fact that literally it's not bespoke. I think it's really important to understand that, when we're talking about investing or anything financial, we call it personal finance for a reason. We have context, we have unique circumstances, and so it is important to understand that by just investing in a broad-based index fund, which is no longer that broad, we're missing out on what is potentially a bespoke solution. So not everybody wants to just invest in the S&P 500. People have very unique circumstances, different goals, objectives, aspirations. People have different risk profiles. And one of the examples I'll give you, Peter, is a lot of the time when I speak to people and I say to them, look, when you're investing, you have to think about your risk. Investing is all about risk and reward. So understand what your risk profile is. And there's different ways to categorize risk. But one of the ways to categorize risk is your tolerance for volatility. And I asked them, if you choose a number between 1 and 7, 7 being the most risky and 1 being the least risky, what number would you choose? What kind of risk can you tolerate? And many people will probably choose 4 because it's bang in the middle, right? It's a balanced kind of approach. And I've said to them, well, if that's the case and you've just invested in the S&P 500, then
Mm,
actually you have not invested according to your risk appetite.
mm,
Most S&P 500 index is actually a 5 out of 7. So it's really important that yes, it's by just investing in something you don't understand, you may not actually be investing according to your risk tolerance. And then the other ones is, yeah, and I think that's the main thing. It's really understanding that we all have different unique circumstances. I'll give an example, another example. Some people are quite ethical or they care a lot about the ethical or social responsible investing. And so if we're talking about investing in the S&P 500 or even let's say the FTSE 100, there are companies in that index that a lot of people may not want to have exposure to. It could be that you don't want to invest in gambling companies, or you don't want to invest in companies that engage in a lot of pollution or fossil fuels and that kind of stuff. So
mm.
yeah, it's just really important to understand that even though it can seem like a one-stop shop, we do all have different circumstances and we have to factor that in.
Finance is personal, man. I love that. Really, really good. Anything else, before, yeah, anything else on, I guess, investing in index funds for our listeners?
Yeah, I think one thing I probably want to add to that is when we talk about index funds, a lot of the time people are talking about one asset class, which is equities or stocks and shares. Right? So when people talk about index funds, they are really talking about the S&P 500. But also what they're probably missing is there is also a world index fund that you can invest in. So it's not just about investing in the S&P 500. That's one thing. And even when we look at that, that's just one asset class. There are a whole other group of asset classes. There are 4 other asset classes that we can invest in, from bonds to property to alternative assets like infrastructure assets and renewable energy and commodities like gold, etc. And so I think it's important to consider that and consider that you can even invest in multi-asset index funds as well.
Love that, love that. For our listeners that are just hearing about multi-asset funds for the first time, check our episode that we done 2 years ago, episode 130, why you may want to consider multi-asset funds. So do check that out. That's episode 130. Now, Jax, I mean, we kind of touched it, but I guess going a bit deeper and building on that, who should and who shouldn't really be, so which type of people should be looking at index funds and who should kind of just, maybe consider other things.
Yeah, I think going back to what I was saying earlier, I think it's really important to understand the risk tolerance of the individual and to really actually read what we call the key investor information document or the fact sheet of the assets you're invested in, especially if they're pooled investments, or what I mean by that is the ETFs, index funds, mutual funds, etc. Because it will tell you what the risk is out of seven. And you then have to ask yourself, do I really want to take that level of risk? So it's really important to understand that. And once you do, you would then ask yourself, wait, is this something you actually want to invest in? If someone said to me on a personal level that, hey, Jax, I've got a certain amount that I want to put away every single month, and I'm not going to be, checking my portfolio every other day or quarterly or anything like that. I might check on a half yearly basis or maybe even once a year. And I'm going to do that for the next couple decades, so 20 years, 30 years, etc. Then I think actually I can't really argue with
Mm,
taking the equity index as the the choice of investment. I think that's actually a fantastic idea for the average person. However, most people don't invest that way, right? People have shorter time frames. Some people have 5 years, which I believe is the shortest time frame for any investment. Anything less than that is quite, you're probably going into speculation territory. I probably say anything less than 3 years is not really investing, it's gambling if you're still investing in risk assets. Um, People have different time frames, different risk tolerances. So I think to answer that question, who kind of should not be investing in index funds? Anyone who actually understands what it is and knows that it doesn't actually fit what they're trying to achieve.
mm. Love that, love that, love that. And I guess we spoke about potentially considering other things and more other options as well. So it'd be good to hear from you, Jax. What are some of those other options, as opposed to index funds? But before we do that, Jax, we're gonna give a shout out to where we are getting listeners from, and this area is called Tanta, which is a city in Egypt.
Oh, fantastic. Egypt is not a country I've actually been to. Probably on the list. Speaking of Egypt, we know a player called Mohamed Salah who has done really, really well for a team called Liverpool. And I'm hoping he doesn't have the best season like he has had over the past 5 years. So, pick up Egypt. Welcome to the Woke Finance podcast. You're here with myself, Jax, and the co-host, Peter. And on this podcast, we talk about all things finance and all things finance related. If you want to know a bit more about what we do, because Woke Finance is more than just a podcast, we do serve in the community here in the UK. Head over to www.wokefinance.co.uk, www.wokefinance.co.uk. But if you want to engage with us on socials, we are on different social media platforms from LinkedIn to Instagram to even TikTok. If you search for Woke Finance, you will be sure to find us. Welcome to the podcast. I hope you were enjoying the episode and gaining tons of value.
Come on, come on, come on. A shout out to our listeners over there in Egypt and all over the world. We appreciate you very much. Now, Drax, what are some of the other options?
Yeah, so there's a whole universe of different options, and I think if we start off from the kind of pooled investment type vehicles, there are actively managed mutual funds, which can have different strategies, ideas, and objectives and stuff like that. Again, remember the type of people that should be considering moving away from index funds and going actively are people that actually understand what the actively mutual funds are trying to achieve as well. If the whole goal of the active mutual fund is just to perform better than the index, then probably you may want to consider if that's what the route you want to go, because only a very, very, very small amount of people are actually able to do that. However, it could be that the mutual fund is considering a much more impactful, socially responsible type of investment strategy by, let's say, restricting investments to certain companies, or on the other side, moving actually so when I say restrict, we call that negative screening, which means they're actually removing any companies that do certain things. And then there's positive screening where they're actively looking for companies that are doing amazing things in the economy. So it's not just about returns, it's about actually making an impact or being socially responsible. So those people should be looking at actively managed mutual funds. And then we have something called ETFs, which are very, very similar to index funds. They're just structured in a different way. But one of the differences between ETFs and index funds is often how it's priced. ETFs can be traded in terms of liquidity. They actually trade on an exchange, so you can buy it in the morning and sell it in the afternoon, which we don't advise, but it's possible should you want access to be able to get your money out quickly. And also ETFs can be a bit more bespoke. Often you find ETFs that may be like index funds, but they may have a very kind of chosen segment of the index, for example. So it could be sector based, like we spoke about earlier, and that kind of stuff. So there's ETFs that exist as well, but a lot of ETFs are very similar to index funds. We have something called investment trusts, also known as investment companies, very, very popular here in the UK, especially with the older investors, which are basically rather than being structured as an index or a mutual fund, they are actual companies. It's just that the goal of that company is to invest your money. So you've probably heard of things like REITs, real estate investment
Mm,
trusts. They are a type of trust, but they focus purely on properties, whereas other investment companies or investment trusts may have a goal of, let's say, investing purely in infrastructure projects, or they themselves may decide to invest in stocks and shares and stuff like that. So they exist as well. And what's good about them is that because they are companies rather than actual funds, they are able to use what we call leverage, or they're able to do gearing. Same thing, really. They're
mm.
able to borrow money essentially and actually behave as a business, which can actually improve your returns over the long term as well. There's more to say about investment trust, but I'm not going to go into the detail because that's not the purpose of this episode. And then there's things like individual stocks, which I believe has space in everybody's portfolio on a personal level. Even if you do invest in index funds, I think it's something that you can look at, which is where you invest in companies that you might believe in, or maybe you've done your research, etc. And the other one is, I think this is one that's probably slept on, which is just using a robo advisor. A robot advisor is basically just using a platform that will ask you the right questions. What's your objective? What's your time frame? What's your risk tolerance? What's your objectives? And based on your answers, they will use algorithms to create a portfolio for you. And then all you've got to do is maybe commit to putting money in every single month. And that's a great way for a lot of beginner investors because it takes away the decision making of having to make a choice, and it is actually investing according to your risk tolerance, which most people don't do when they invest in index funds. And then the last one is to actually use a financial planner or a wealth manager or investment manager, whatever you want to call it, and they serve a purpose, especially if your situation is a bit more complex, and you need someone to actually sit down and draw up a much, much more holistic financial plan. And once you draw that holistic financial plan, what you find is that your investment strategy is part of that plan, is there to help you achieve a very specific goal rather than just investing for returns. So those are the different options available. But I'm sure I probably missed out a few others, but those are the ones that come to mind, and I think people should really consider.
No, that was such a range of alternative options. So no, thank you for that, Jax. And for our listeners, I mean, on most, if not all of these, we've got separate episodes on. We've spoken about choosing the right financial planner, for example. We've spoken on investment trust. Episode 196, we touch on the option that Jack said is probably one of the most slept on, and that's robo advisors. So that episode is called Robo Advisors and ETF Allocations. That's episode 196 here on the Woke Finance Podcast. So do search that and have a listen. So now, Jax, thank you very much for that. It's so good to just, I mean, again, this is all about personal finance, what works for the individual listening, what works for you on your own journey as well. So it's just important, that there are people are able to hear about what we talk about on these podcasts so we can make more better informed decisions, so to speak. So now thank you for that, Jax.
Well, you're welcome. I think it's really important, and that's why we do the podcast to inform people. I think it's very easy to hear someone like Warren Buffett talk about index funds and just to go with it. I think as human beings, Peter, we often love to take what we call the path of least. Well, how does it go? The path of
Least resistance.
least resistance. And so, we hear something that sounds very simple, very easy, and we just, especially when we hear that you're going to outperform most mutual funds, then of course that's the easy thing to do, and we go ahead and do it. But I think it's important that we analyze that, evaluate it, and ask ourselves the right questions to see actually does that make sense for our personal circumstances.
And I think that's very important, Jax, man. Warren Buffett is obviously Warren Buffett. You can't ever take away what he's achieved, but he is Warren Buffett. You're Jax, I'm Peter. Everyone's lived their individual lives, so some people can say things people say things based on the lives that they've also had and the world around them and how they view it. Um, some people are not in a position to make Warren Buffett moves. So I think it's so important that we're able to really personalize things to our own lives, if that makes sense.
Absolutely, Peter. Absolutely. And I think one of the things that I've been practicing over maybe a couple of years now, to try and challenge my own thoughts my own thoughts and beliefs is sometimes just, I basically argue against myself and I say, okay, this is something I've heard. This is something I believe. If I was to do a debate and I had to argue against it, what would I say?
Mm,
How would I win that argument?
mm,
And if we're able to think this way, actually, you're able to analyze and critically evaluate, critically analyze our own thoughts, our beliefs, and what we've heard to help us make better informed decisions and better conclusions.
mm. Love that, love that, love that. Okay, on that note, again, we've obviously spoke fairly positively about index funds, but we've given a balanced discussion. On that note, and I've heard this several times, should everyone essentially when it comes to investing, Jack, should everyone just literally put it in to index funds, which seem, low maintenance, fairly straightforward, generally good performance as well. So yeah, my question to you, Jax, those are on an investing journey. Just to make things simple, no wahala, should we just put our monies in index funds?
I think most people should definitely start considering it. I think it should be a starting point and it should be something that should be considered. But then with that consideration, you have to think about the other alternatives as well. So if the average person wants to invest for a few decades and they're willing to commit some funds and dollar cost average and they're willing to ride out the volatility or not even check their portfolio to see the volatility, then actually, yes, the average person probably should be focusing on index funds to form the core, at least the core of their portfolio. However, like we've been saying the whole episode, everybody has their own unique circumstances. The context is important. And for that reason, I think most people should really, really think about considering other means of investing, not just investing in index fund because they've heard it from someone. They should do the research, and after the research, they can still decide, hey, after all that I've learned, all that I've understood, index funds is still the way to go. Those people should be investing in index funds. And I do want to say one last thing, actually. It is actually virtually impossible for everybody to invest in an index fund. It just it can't run. The whole point of investing in index fund is because we believe that the stock market is efficient, which means it prices things perfectly or very well, and nobody can make excess returns by having better information or doing some sort of better analysis, etc. That efficiency of the market can only take place if we have active people in the market because the active people in the market are the ones that keep the stock market honest, right? Think of it like this. If everybody was, let's say, shopping in Tesco, and Tesco is the only place that we can shop, or for American listeners, let's say everybody shopped in Walmart, and that's the only place you can shop, and no one looked at what's happening with other supermarkets like Sainsbury's or Target or Costco or whatever. Then the company or the supermarket can charge whatever price they want and everybody will buy it because everybody is just buying the index, all right? Or
Mm,
everyone's buying from the store. However, there are people, trust me, Elizabeth next door, who's 75 years old, who goes to the shop and compares what's happening in Tesco to Sainsbury's or what's happening in Walmart to Target, and actually asking, why does this cost £1.50 extra or even 20p extra or a few cents extra? Why is that the case? Because that person is actively making that decision. That person is extremely important because they keep the supermarket honest.
mm,
That creates further efficiency. So what I mean by that is we can only continue investing in the index as an efficient market if we have active people in the market. And if you get to a place where too many people aren't in the index, then you're going to get people that can make excess returns by being active. That said, sometimes we should leave the active investor maybe to Wall Street or leave it to the professionals who have very, very specific software goals, etc.
Mm. I love that. I love that bit of education. I think sometimes we can be involved in something because for a lot of our listeners, we're involved in the stock market in some capacity, even if we're passive. But it's just good to understand, what's actually happening and the different things that make things move and how one thing can't move without the other. So, no, thank you for that insight, bro.
No worries, no worries. A bit of education there.
Love it, love it, love it, love it, man. Well, hopefully that was enough education on all things. Well, not all things, but most things index funds as well in relation to why it's so topical at the moment, for our listeners. So hopefully that was quite useful for you. As per usual, if you have any questions, you have all of our socials. If not, check out wherever you're listening to this, it will be there. If you've got any follow-up questions or any other thoughts that you want to share, do that. The usual, if you've never ever left a comment and you've listened to at least one of our episodes, come on, man, just leave a nice comment, a 5-star rating, a like, subscribe, all of that good stuff. It really does help us. And it's your way of saying thank you for whatever value we've given to you. So thank you very much once again to our listeners. Jax, always a pleasure. Until the next time. And remember all,
Um,
stay woke.